Welcome back to the Deep Dive. We are digging into a pretty dense stack and analysis today, looking at Performance Food Group Company, PFGC. Right, so our mission here is really to get under the hood of their strategy, their risks. They're the second largest publicly traded food service distributor in the U.S. And, you might think food distribution is kind of sleepy, maybe predictable. Not PFGC. They are anything but conservative right now. They're pushing this huge M&A-fueled growth strategy, grabbing market share. Mostly, it seems, from the big guy, Cisco. So the big question we're trying to tackle is this growth, this debt-fueled expansion, actually sustainable? Or are they maybe taking on, well, too much risk? PFGC is really at a critical point.
Yeah, a major inflection point. And it's being shaped by two really seismic events that the sources we looked at cover in detail. First, you've got the arrival of a pretty heavy-hitting activist investor that changes the whole dynamic. And second, there's this serious talk, now confirmed, about exploring a potential mega merger with their competitor, U.S. Foods. So this deep dive is built on analysis that really lays out the trade-offs. PFGC's roll-up strategy, that's what they call it. It's basically buying up smaller players, regional guys usually, aiming for massive scale, hoping to get better margins later through buying power and efficiency gains.
Right. So the core question for you listening in is really this. Does PFGC's faster growth plus the potential for this huge merger justify its higher valuation? It's trading richer than Cisco, the market leader. Or are the risks just too high? The debt, the integration challenges, and those big regulatory hurdles for a merger.
Let's unpack PFGC piece by piece. All right, let's start with just the sheer size of this thing. Performance Food Group, based in Richmond, Virginia. I mean, it's huge. We're talking over 30,000 employees, serving more than 200,000 locations. That's everything from like your local diner to hospitals, even prisons.
And the logistics are just mind-boggling. They distribute something like 300,000 different products. SKUs, That's more individual items than a giant retailer carries, and it all flows through this network of 77 distribution centers. Getting that efficient is everything in this business. It's tough.
Yeah, they call it a penny business for a reason. What's interesting about PFGC, though, especially compared to Cisco, is this multi-segment structure they have. It's deliberate. It's about diversification, building resilience. So if one part of the market, say restaurants, takes a hit, they've got exposure elsewhere like convenience stores or vending. They run on three main pillars.
Okay, let's hit the first one, the big engine, food service.
Right. Food service. This is the core, the traditional broadline distribution. It's the largest segment, drives most of the growth and profit. This supply everything, meat, produce, paper napkins, cleaning supplies, to restaurants, both independent and chains, schools, healthcare, you name it. But the real focus, the thing management talks about all the time, is the independent restaurant channel.
Why the independent specifically? Well, they see it as a huge growth area and critically more profitable. Independents often buy more of PFGC's own brands, their private label stuff, and they rely more on the sales reps for advice, for menu ideas, value-add services. Chains just squeeze you on price. Independents pay for that extra service, so margins are better.
And the numbers back that up, right? Looking at Q1 fiscal 25.
Exactly. Food service net sales hits $7.7 billion. That's up 5.7% year over year. Solid. But look at the adjusted EBITDA growth, $280 million, up almost 14%. That shows they're getting operating leverage, better margins from that focus. It's definitely the profit powerhouse.
Okay, pillar two, convenience. This is the Core-Mark piece they bought.
Right. Core-Mark acquired back in 2021. This is their big diversifier. Core-Mark is a major player distributing to convenience stores. So think snacks, candy, drinks, tobacco, lots of non-food items, high volume stuff.
And that volume versus margin thing really shows up here, doesn't it? The estimates for FY25, convenience is like 43% of total sales. That's massive volume.
Huge volume, but, and this is the trade-off, it only brings in about 23% of the total adjusted EBITDA. So nearly half the sales, but less than a quarter of the profit. It definitely pulls down the overall company margin profile.
But it provides stability, bulk.
Exactly. Stable revenue, access to a different market, and even in that lower margin space, Core-Mark seems to be running pretty efficiently. Adjusted EBITDA grew over 11% in Q1, so it serves its purpose.
All right. Third pillar, Vistar, the specialist.
Yeah, Vistar is more niche. It targets specific non-restaurant channels. Think movie theaters, big vending machine operators, office coffee services, even some big box retail.
What's interesting with Vistar is how it's adapting. It grew well in FY24, partly by pushing into newer areas like online order fulfillment, specific e-commerce logistics. It shows PFGC knows distribution isn't just about trucks anymore. They're looking at these high-growth adjacent areas.
And speaking of expansion, we should mention that geographic move in July 2024. They bought Jose Santiago Inc. in Puerto Rico.
Right, their first step into the Caribbean,
Yeah.
largest distributor there. That feels like a classic tuck-in acquisition, doesn't it? Part of that roll-up playbook.
Absolutely. It's a perfect example. Even while they're talking about merging with U.S. Foods, this massive deal, they're still executing these smaller strategic buys. It gives them a dominant spot in a new market, probably less competition than on the mainland. It keeps that M&A engine running. Okay, so to really get why PFGC's moves are so high stakes, you got to understand the industry landscape. Food service distribution, it's enormous. U.S. sales were, $382 billion back in 2022? But it's mature, and like we said, notoriously low margin. A real penny business. Tiny efficiencies make or break you.
But there's still growth projected, right? A pretty healthy clip.
Yeah, the overall U.S. food service market, people eating out, getting food delivered, that's expected to grow around 7% a year through 2032. That's a big pie getting bigger. So if you're one of the giants, even grabbing a small slice of that new growth is billions in extra revenue. Worth fighting for.
And the fight is dominated by the big three. Let's lay them out.
Right. First, the undisputed king, Sysco. SYY is the ticker. They're projecting over $81 billion in sales for FY25. That gives them about 17% market share. Their scale is just immense. 337 distribution centers, 730,000 customers. They really set the operational benchmark.
Then there's our focus, PFGC. $63 billion in FY25 sales, maybe 13-15% market share. Gaining ground.
And third is U.S. Foods, ticker USFD, about $38 billion in FY24 sales, holding maybe 8-10% share.
So those three together, that's almost 40% of the whole market.
Roughly, yeah. But that means 60% is still fragmented. Thousands of smaller regional distributors out there. And that fragmentation is exactly what fuels the roll-up strategy. It's why M&A is the name of the game for the big three.
So if the margins are so thin, what stops, like a tech startup, from just disrupting everything? What's the moat around these giants?
It's formidable. The barriers to entry are just huge, multi-billion-dollar barriers. First, you've got economies of scale. Size gives you buying power. Sysco or PFGC can negotiate way better prices from food manufacturers than any regional player can dream of. Combine that purchasing clout with optimized national logistics, their cost per case delivered is just lower. Hard to compete with that.
Okay, scale is one. What else?
Second, sheer capital intensity. Building a national network like theirs, billions. You need modern refrigerated warehouses, a huge fleet of specialized trucks, sophisticated inventory tech. It's prohibitively expensive for newcomers.
Makes sense. And the third piece locks in the customer.
Yeah, switching costs. If you're running an independent restaurant, changing your main food distributor is a major pain. You've got to retrain your staff on new ordering systems, build relationships with new sales reps, maybe even change menu items if your favorite private label sauce isn't available from the new guy. That friction makes customers sticky. They tend to stay put.
Okay, so within this big industry, there's a specific battleground where things are really heating up: independent restaurants.
Exactly. That's where the real profit is. Independents made up almost 60% of distributor sales in 2022. Like we said, they value service by higher margin products.
And this is central to PFGC's story right now.
Yeah.
They've been taking serious share from Sysco in this key channel.
The numbers are stark. PFGC's independent case volume grew almost 6% in the last quarter of fiscal 25. 6%. Meanwhile, Sysco's equivalent volume, what they call local volume, actually fell 3.5% in the same period. That's a huge swing.
Wow. So what happened? How did PFGC manage that?
Well, some of it is good execution by PFGC, but a lot of it was accelerated by what the sources call Sysco's self-inflicted execution failure. Sysco tried to overhaul how they pay their sales reps, and apparently it didn't go well. Created confusion, maybe demotivated reps.
The sales reps are crucial for independence, right? They're the relationship holders.
Absolutely critical. So
Yeah.
if Sysco's reps are distracted or unhappy, it creates an opening, a strategic window for PFGC and U.S. Foods to swoop in and grab those accounts. PFGC capitalized brilliantly.
But wait, if Sysco fixes its sales comp plan, and you have to assume they're trying desperately to do that, does PFGC's advantage just evaporate? What's the backup plan if that independent growth stalls?
That is the million-dollar question, or maybe billion-dollar question, given the valuations. It's the key risk to PFGC's organic growth story. How much of their recent success is truly superior execution, and how much is just capitalizing on Cisco fumbling the ball? If Cisco gets his act together, stabilizes that sales force, you're right, the battle for independent accounts gets way tougher. PFGC's growth likely slows, and that puts even more pressure on the M&A strategy, especially the potential U.S. foods deal, to deliver the growth investors expect.
Okay, so that tension organic growth, possibly boosted by a rival's mistake versus relying on these big acquisitions, leads us straight into the two huge events that really shook things up for PFGC in 2025.
Right. First, the potential U.S. foods merger. This is the game changer everyone's watching. News started bubbling up around July 2025. Then in September, it got real. Both companies confirmed they had a mutual information sharing agreement. They're officially looking at the regulatory side, the potential synergies. It's like they're seriously checking if the wedding is even possible before sending invitations.
And the scale is just massive if it happens.
Combining number 2 and number 3 creates a new number 1. Almost $100 billion in combined annual sales. That would give them maybe 18% market share, just sneaking past Cisco. It completely redraws the map. Instead of 3 giants, you'd have 2 dominant players facing off. A true duopoly at the top.
The elephant in the room is antitrust. Regulators, specifically the ghost of 2015.
Exactly. You can't talk about this without remembering that the FTC blocked Cisco's attempt to buy U.S. foods back then, killed the deal dead on competition grounds.
What was the specific argument the FTC made in 2015? Why did they block it?
Their main concern was about the market for national broadline distribution, specifically serving large, multi-regional chain customers. Think big restaurant chains, hotel groups. The FTC argued that combining Cisco and U.S. Foods would leave these big national customers with basically only one viable nationwide supplier. Too much concentration, leading to higher prices, maybe worse service for those specific customers.
So how could PFGC and U.S. Foods possibly convince regulators this time, given that precedent? What's different now?
It's a tough sell, no doubt. They'd probably argue a couple of things. First, maybe the relevant market has changed since 2015. With the rise of more specialized distributors, those e-commerce platforms PFGC is buying, maybe the market is actually more competitive now, even with consolidation at the top. Second, they might try to argue their combined strength is more focused on the independent restaurant segment where there's still tons of regional competition, rather than locking up those national accounts that worried the FTC last time.
Feels like a long shot, but maybe plausible.
It's definitely an uphill battle. That 2015 ruling guarantees intense scrutiny. Success is far from certain.
Okay, so while all this merger uncertainty is swirling, another bomb drops. The activist investor. Sachem Head Capital Management.
Right. Sachem Head shows up. They're a well-known activist fund, often pushing for big strategic moves to boost shareholder value. M&A is frequently their playbook. They send a board nomination letter in early September 2025, and things moved fast.
Really fast, it seems.
Incredibly fast. Just 3 weeks later, end of September, Scott Ferguson, Sachem Head's boss, is appointed to PFGC's board. No proxy fight, just boom, he's in.
What does that speed tell you? Seems like the board wasn't putting up much resistance.
It suggests strong alignment, or at least a quick recognition that fighting wasn't worth it. The activists arriving right when merger talks are serious fundamentally changes the story. Now you have a powerful voice on the board whose main goal is maximizing shareholder value, very likely by pushing the U.S. Foods deal over the finish line, or, if that fails, demanding some other big move to close that valuation gap with Cisco. It just ramps up the pressure for a major transaction.
And amazingly, even with all this high-level drama, the potential merger, the activist landing on the board, PFGC, is still doing its regular M&A thing.
Absolutely. That roll-up engine keeps humming. The biggest recent deal, besides the potential U.S. Foods one, was Cheney Bros, Inc. Cheney is a big distributor down in the Southeast. Buying them gave PFGC a big immediate boost to revenue and case volume in fiscal 25.
But big deals like Cheney also add costs, right?
Yeah.
That's part of the financial paradox we need to get into.
Precisely. Deals that size are a major reason why operating expenses, interest costs, depreciation, all those things weighing on the official GAAP profits are going up. Beyond Cheney, they did other deals too. OLM Foods, bolstering that convenience segment. And interestingly, Green Rabbit.
Green Rabbit, that's the e-commerce one.
Yeah, an e-commerce fulfillment platform. Buying them doubled PFGC's capacity in that space. It shows they're not just consolidating old school distribution, they're actively buying tech and capabilities for the future of logistics too.
Okay, let's dive into the numbers. This is where the strategy meets the spreadsheet and it gets, well, complicated. We've said PFGC's strategy delivers growth, grabs market share. But it comes at a cost. Lower short-term profits, lower efficiency compared to peers. Let's break down how the roll-up strategy hits the financial statements.
This is the core of it, what we're calling the financial paradox, and you see it perfectly in the gap between GAAP and non-GAAP numbers. Management, understandably, loves to talk about the non-GAAP metrics, especially adjusted EBITDA. Why? Because it looks great. FY 2025. Net sales up 8.6% to $63.3 billion. Adjusted EBITDA jumps a huge 17.3% to $1.8 billion. Looks fantastic, right?
High growth.
Sounds great. So what's the catch? What are the GAAP numbers showing?
The catch is when you look at the official audited numbers, generally accepted accounting principles, GAAP, the story completely flips. GAAP net income, the actual bottom line profit, fell 22% in FY25 down to $340 million. And GAAP diluted earnings per share dropped almost 22% too.
Okay, hold on. Adjusted EBITDA soaring, GAAP net income plummeting. How does that work? Explain the mechanics of how the M&A is causing that gap decline. It's the direct cost of growth hitting the income statement in a few key places. First, depreciation and amortization. When PFGC buys a company like Cheney Bros, a big chunk of the purchase price gets recorded as intangible assets, things like brand names, customer relationships, goodwill. Accounting rules say you have to amortize these intangibles, basically write them off as an expense over several years. It's a non-cash charge, but it reduces your GAAP profit. More big deals mean more amortization, dragging down net income.
Okay, so amortization is one big factor.
For a second big one, interest expense. How is PFGC funding these deals? Often with debt. They issued $1 billion in senior notes just in FY25. All that borrowing means huge interest payments. And unlike amortization, interest is a very real cash cost. It gets deducted before you calculate GAAP net income. More debt equals higher interest expense equals lower GAAP profit.
Got it. So adjusted EBITDA basically strips out those M&A-related costs, the amortization, the interest to show the underlying operational performance before financing and accounting impacts.
Yeah.
But GAAP net income shows the true bottom line after all costs, including the cost of funding the growth strategy. So operationally strong, but financially less efficient right now because of the strategy.
Exactly. And that low efficiency jumps out when you compare their margins directly to peers using that adjusted EBITDA margin metric.
How bad is the gap?
It's pretty stark. PFGC's adjusted EBITDA margin in FY25 was 2.8%. Cisco, 5.3%. Nearly double.
Double, wow. And U.S. Foods?
U.S. Foods is also well ahead. They hit 4.6% for their full fiscal 24 and even managed a record 5.4% in their latest quarter. So PFGC is lagging significantly behind both main competitors on core profitability.
Why such a big difference? Is it just that lower margin convenience business pulling them down?
That's part of it, yes. The business mix matters. Core-Mark inherently has lower margins than the food service side, but it's more than that. It's also about operational maturity and integration complexity. Cisco has spent decades fine-tuning its network, its systems. They're incredibly efficient. PFGC, because of the roll-up strategy, is constantly digesting new companies, integrating different warehouses, different IT systems, different sales cultures. That's expensive and takes time. It inherently keeps margins lower while they're in this rapid growth by acquisition phase.
Okay, so lower margins. That brings us to the ultimate test of whether this strategy is actually creating value. Return on invested capital, ROIC. This tells you how much profit they're generating from all the money, debt, and equity they've poured into the business, especially into these acquisitions. If Cisco's margins are double, how does PFGC's ROIC look?
Not good. This is probably the most concerning metric for the Bears. PFGC's current ROIC is down around 4.7%. Return on equity is about 7.9%.
And Cisco's ROIC?
Cisco's is a stunning 17.6%. Their 5-year average is over 12%.
Whoa. Okay, let's put that in plain terms. If you invest $100 into PFGC's strategy today, you're getting back about $4.70 in operating profit. Invest $100 in Cisco, you get back $17.60.
That's the harsh reality of it. The massive gap shows that while PFGC is successfully growing its asset base through M&A, it hasn't yet figured out how to generate profit from those assets nearly as efficiently as Cisco does. The market's premium valuation is essentially a huge bet that PFGC can close that ROIC gap over the next few years, either through better integration or more likely through the synergies of the U.S. Foods merger.
But despite the low ROIC, the falling GAAP income, they are still generating cash.
Right.
That's crucial.
Absolutely critical. That's the lifeline. Cash flow remains strong. In FY25, they generated $1.2 billion from operations, which left them with over $700 million in free cash flow after CapEx. That free cash flow is what allows them to service the debt and keep the M&A engine fueled. Without it, the model collapses.
But even with cash flow, you mentioned potential inefficiencies, working capital.
Yeah, there's room for improvement there too. If you look at their working capital efficiency, measured by the cash conversion cycle, or CCC, the CCC tells you how quickly a company turns its investments in inventory and other resources back into cash. PFGC's CCC is around 20 days.
Is 20 days good or bad?
It's okay for this kind of logistics business. But U.S. Foods is much better around 10 days. Sysco is slightly better than PFGC, around 18 days.
So U.S. Foods turns its inventory into cash twice as fast as PFGC. What does that mean practically? How could PFGC close that gap?
That 10-day difference means U.S. Foods has hundreds of millions less cash tied up in working capital compared to PFGC. It's a big efficiency advantage. To catch up, PFGC needs to get much tighter on inventory management, hold less stock, turn it faster. That requires really sophisticated forecasting and warehouse ops, which is harder when you're constantly integrating new, different systems. They also need to optimize payables and receivables, stretch out payments to suppliers while collecting cash faster from customers. It takes time and operational discipline, especially in a decentralized system born from acquisitions.
And finally, just running this whole network costs money. Capital expenditures.
Right. It's a moderately capital-intensive business. CapEx was over $500 million in FY25. That's about 42% of their operating cash flow, just going back into maintaining and upgrading trucks, warehouses, tech. It just reinforces why improving those operating margins and ROIC is so critical when a big chunk of your cash is already spoken for just keeping the lights on. Okay, so given those financial pressures, the low ROIC, the high debt, how does PFGC plan to convince the market this strategy will pay off? Their blueprint seems to be about proving they can both integrate the deals and keep winning organically. On the organic growth front, it all comes back to those independent restaurants. That 4.6% organic case volume growth in FY25 is their proof point. They argue it shows their focus is working, partly thanks to those Sysco stumbles we talked about, but also because of their own efforts. Management keeps saying they're investing heavily in developing their own proprietary brands, those higher margin products independents like, and crucially, expanding and training their sales force.
The idea being that a better sales force focused on independence is a lasting advantage.
That's the thesis. A bigger, more knowledgeable sales team that really partners with those higher value customers. They believe that's sustainable.
And then there's the inorganic growth, the M&A piece. That sounds like that's evolving too, not just about getting bigger.
Right. It's becoming more targeted. You still have the tuck-in deals, like buying the top player in Puerto Rico for geographic dominance, bolt-ons. But you also have strategic channel acquisitions, like buying Green Rabbit for e-commerce fulfillment. That's about buying future capabilities, not just current market share. And linked to that is this push to capture higher margins by moving up the value chain.
Going beyond just delivering boxes.
Exactly. Since basic distribution is so low margin, you have to find ways to add services that customers will pay more for. The perfect example is that new meat processing facility they opened in Wisconsin in May 2025. Instead of just delivering cases of pre-cut steaks, now they can offer custom cutting, portioning, maybe even aging or marinating, value-added services.
And those services command better prices, better margins.
Surely. Yeah, and they also make the customer stickier. If a restaurant relies on PFGC for unique, custom-cut proteins, it's much harder for them to switch distributors. It's all about embedding themselves deeper and justifying a higher price point to help close that margin gap with Sysco.
Okay, let's talk about the money side again, capital allocation. With such an aggressive M&A strategy, where does the cash go? And what about the debt?
Management's priorities seem crystal clear from their actions. M&A comes first, then reinvesting in the existing business organically. Shareholder returns are clearly third. And that M&A focus has definitely led to a more leveraged balance sheet. That $1 billion senior note issuance in FY25 is a prime example. They're borrowing heavily to grow.
How stretched are they? You mentioned the interest coverage ratio earlier.
Yeah, it's modest, around 2.28. That means they generate about $2.28 in operating profit for every $1 they owe in interest. It's not in the danger zone yet, but it's tight.
Yeah.
It leaves very little room for error if earnings dip or interest rates spike further. They are definitely prioritizing growth over having a fortress balance sheet right now.
What about returning cash to shareholders?
Yeah.
No dividend, right? But they did announce a big share buyback.
No dividend, correct. But yeah, the new $500 million share repurchase program announced in May 2025 was significant. And the timing was interesting.
How?
It came just before the serious merger talks with U.S. Foods became public knowledge. You could interpret that as management signaling to the market, hey, we think our stock is cheap on its own. Maybe trying to set a higher floor valuation heading into those crucial merger negotiations. It's a confident signal. And finally, you have to look at management and governance alignment. George Holm, the CEO, has obviously orchestrated this whole aggressive growth phase. Insiders own about 1.5% of the company, which is worth over $250 million. That's a decent chunk, usually helps align their interests with shareholders.
But the real governance wildcard now is the activist Scott Ferguson on the board.
Absolutely. Having Sachem Head represented directly on the board changes the dynamic completely. It guarantees there's a powerful, independent voice, laser focus on maximizing value, and the most obvious path to that right now is executing the U.S. Foods merger successfully. His presence dramatically increases the odds they push forward with the deal if there's any regulatory path forward at all.
All right, let's try to pull this all together. We've got this picture of PFGC. Faster growth than peers, winning share, but fueled by debt, leading to lower margins and much lower returns on capital, at least for now. So why on earth does it trade at a premium valuation compared to the efficient giant, Sysco?
It's the million-dollar question, isn't it? PFGC's valuation, looking at EV to adjusted EBITDA, is somewhere in the 14x to 15.5x range. Sysco is lower, maybe 11x to 12x. The market is clearly paying up for one thing: growth. PFGC is delivering much faster top-line growth and taking that valuable independent restaurant share. That premium is essentially baking in a lot of future optimism. Investors are betting that PFGC will successfully integrate these deals, that margins will improve, that ROIC will eventually catch up, and crucially,
That the U.S. Foods merger actually happens and unlocks huge value.
exactly. The potential for that transformative merger is a massive part of the current valuation premium. It's a growth and M&A story, not a current profitability story.
Okay, but that premium valuation rests on shaky ground. Let's hammer home the key risks. The bear case. What's the absolute biggest threat?
Without a doubt, regulatory risk around the merger. If the FTC steps in and blocks the U.S. Foods deal just like they did in 2015, that's catastrophic for the current bull thesis. It pulls the rug out from under the biggest potential catalyst. The stock would almost certainly re-rate downwards significantly as investors are forced to value PFGC on its standalone, lower margin, lower ROIC reality. That's risk number one by far.
What other major risks are there, even if the merger wasn't on the table?
Well, the core strategy itself carries risk. Call it roll-up strategy failure. What if they can't integrate a huge deal like Cheney Bros smoothly? You could see operational chaos, missed synergy targets, maybe the debt load becomes unsustainable if profits don't materialize as expected. A major integration stumble could be really damaging given their current leverage.
And the competition isn't standing still.
Right. The competitive reassertion risk. We keep coming back to Sysco. If they fix their sales execution problems, that independent restaurant growth engine for PFGC could seriously sputter. Suddenly, PFGC has to fight much harder for every case, putting more pressure on those value-added services to deliver margin expansion in a tougher environment.
And just the basic business risk.
Yeah, economic sensitivity. Food service distribution is tied to people eating out, businesses ordering supplies. A bad recession hits restaurant traffic, corporate spending. That means lower volumes and pressure on margins for everyone, but especially for a leveraged player like PFGC.
Okay, so those are the big worries. What needs to go right for the bull case to play out and actually justify this premium valuation long term?
First, they need to prove their advantage in the independent channel is real and lasting, not just a result of Sysco's temporary weakness. Keep delivering that superior organic growth. Second, integration. They have to successfully digest these acquisitions, leading to clear, undeniable improvements in ROIC and a gradual reduction in debt. Show the roll-up is actually creating value, not just scale. Third, those investments in things like the meat plant need to pay off. Margin expansion has to become visible in the numbers, closing the gap with peers.
Another big one.
And the grand prize, successfully navigating the FTC and executing the U.S. Foods merger. Then, crucially, delivering on the promised cost and revenue synergies quickly. That's the clearest path to justifying the current stock price.
So for anyone listening trying to track this complex situation, what are the absolute key metrics you need to watch?
Based on the analysis, I'd focus on four things relentlessly. First, organic independent case volume growth. Is PFGC still beating Sysco? If that slows dramatically, the core organic story is broken. Second, adjusted EBITDA margin. Is it trending up? Are they actually closing that huge gap with Sysco and U.S. Foods through scale or synergies? Third, net debt to adjusted EBITDA. Is that leverage ratio coming down over time? They need to show they can handle the debt load. And fourth, maybe the most critical long-term indicator for this strategy, return on invested capital, ROIC. Is it improving? Is the money they're spending on M&A actually generating a decent return? If that ROIC stays stuck below 5%, you have to seriously question if the strategy is ultimately building or destroying value.
Wow. Okay, this has been a really deep dive. PFGC is definitely not a simple story. It's this mix of aggressive growth, winning market share, but financed with a lot of debt, leading to complex financials, strong cash flow, yes, but weak GAAP earnings, and frankly, poor returns on capital right now.
Yeah, the takeaway really is that investing in PFGC today isn't primarily about the nuts and bolts of food distribution. It's a bet on high-stakes corporate finance execution and navigating some incredibly tricky regulatory waters. The company's entire trajectory and maybe the structure of the whole industry really hangs in the balance waiting for that U.S. Foods merger decision.
Which brings us to our final provocative thought for you, the listener. We know the FTC blocked Cisco U.S. Foods in 2015 over market concentration concerns. So let's imagine they do block the PFGC U.S. Foods deal now on similar grounds. What could PFGC possibly do then besides just buying back more stock? What strategic operational moves could they make immediately to convince a skeptical market that their high-debt, growth-at-all-cost strategy can actually deliver acceptable margins and shareholder value all on its own? What's Plan B?